Good morning. You may be tuning in to the Monday market update like your normal Monday morning routine and expect to see a Monday market update, but instead, I got a commercial for you. Would you like a high-paying, fast-paced, full energy career change? That's right. How would you like to be an air traffic controller? Did you know there is a national shortage for air traffic controllers? I know that there is a national shortage for air traffic controllers because I'm sitting here running on like 3 hours of sleep after 8 delays yesterday trying to fly from DFW to beautiful Salt Lake City, Utah. And Mr. Katie, my good friend and cohort compatriot, is currently sitting in the Centurion Lounge, probably having a mimosa. And honestly, he's probably doing real well right now. My delays yesterday were 25 minutes at a time. So there was no lounge access. There was no good stuff. No relaxing, chilling. No, it was awful. But I'm here. And so we're going to run through real quick, hit all the key points, all the talking points, everything that you need to know to get on through your week, talking about what has happened, what's happening next, and where do we go from here? Because we do have a bit of a shakeup compared to where we've been the last few weeks. So I want to get right into it, talk about what's been going on. You know, the volatility meter, guess what? I wasn't here early enough to reset this. And so we're going wheels off. You know, it shows mid. It's not really mid. Last week's rates, they were mid until Friday. Then they took off. So I'm going to just ask you to use your imagination on this little arrow and take it from that midpoint and let's bump that up a little bit, like 75%. High mid. We got a lot of movement late last week after some smoothness early. And as you can see, it's going in the wrong direction. So we're going to talk about why, what happened, and where do we go from here. So what was in last week's econ data, econ count? You know, we've been talking for a long time that the data doesn't matter. Data doesn't matter. It's all war headlines. War headlines are everything. Well, what happens when war headlines start to mix with other headlines? What happens when analysts believe that war headlines are directly contributing to the other headlines in econ data? So there's lots of red on here, lots of big, important things that didn't really matter. You know, last week was all about jobs. We had, you know, JOLTS job openings. Okay, that hit just about normal. We had ISM manufacturing, a little up, cool. Okay, a little higher. We had Thursday, we had jobless claims. Those came in a little higher, but continued claims were flat. Looked like labor was pretty smooth until we get to Friday. You already saw what happened. Rate shot up on Friday. But why? Here's why. So two things happened Friday. Non-farm payrolls, NFP. First Friday of the month, the jobs report, the big bad jobs report. We had, and we talked about this last week, there was room for, as Andrew loves to call it, a gangbusters job report. I don't know who uses the term gangbusters, but someone like Andrew Katie uses the term gangbusters. Would be jobs coming in a whole lot higher. So we had an 85,000 job added forecast, and we came in and gangbusted it at 172,000. That's a big beat. That's a lot of jobs added. 172,000 jobs added is pretty big during any type of economic movement. It's a whole lot bigger when you're forecasting 85,000. You know, we're forecasting fewer jobs being added. We've got some more jobless claims. So like, why in the world would we destroy our estimates? That's a great question. Andrew also loves going back over and ripping the BLS, a new one for their BS, on their revisions. And I get it. It's hard to have accurate numbers here, and you got to go back and revise and look at this stuff. But just the previous month's analysis for non-farm payrolls was 115,000 jobs added. Seemed reasonable at the time. That has been revised to plus 179,000. That's a pretty big miss. That's a big gap, and that's a lot more jobs added. So not only did we add 179,000 jobs legitimately after this first revision last month, but the current month adding 172,000 jobs are on fire. That is a huge beat. And why would rates go up when there's a whole lot of jobs added? That's the part that I'm going to explain real quick because it's the most relevant takeaway. And it's something I want you to help understand so you can share it and convey it with people who matter. And, just so you understand. So we got labor, we got inflation. When jobs are coming in hot and heavy, when companies have a need for manufacturing, for production, for any sector, it's going to send more money through the economy, which ultimately leads to inflation. Inflation is a natural result of geopolitics, of economics, of money getting moved around from person to person, country to country, businesses pass through. Currency is a crazy wild thing, and it's almost like it's alive. It moves and it grows, and inflation is going to happen naturally in any kind of balance cycle. When you're adding a lot of jobs, you're adding new movement, you're adding things that means companies have more revenue, are moving things through. So adding a whole bunch of jobs points to inflation going up. We already have inflation going up. Those numbers have been there. So if you're adding jobs, if inflation's going higher, interest rates have to go up. Interest rates need to go up to balance that, to slow that down. Because what you can't have is, rampant hiring everywhere. And, like we saw in 2021-ish, where companies were having to beg to get employees and, they just couldn't keep up with demand. They couldn't keep up with manufacturing. And what did we get from that? Massive inflation. So all it's to say, jobs getting added at a really, extraordinary rate is going to lead to higher inflation, higher costs, and it leads to the Fed needing to increase interest rates to help balance that out. So that's why crushing it on the jobs report, not great for interest rates. It's good for people that need jobs, but not good for the things that we're talking about. So that's last week. That's the big stuff. That's what I wanted to focus on more than anything else. Let's talk a little bit about what we have going on this week. We're putting the target here on Wednesday. Wednesday is a big day. When you have a jobs report like that, that absolutely defies expectations, shows that we're not doing a great job of forecasting things right now, then you're going to worry about some of the inflation. Again, half of what we talk about is inflation and labor. Labor, inflation. Those are the two main factors when it comes to econ policy in the Fed until we're at war with Iran and then everything else changes. But hey, this week, I should say, is inflation week. So Wednesday, we got core CPI, headline CPI. This is a big one. And right now, we're forecasting this inflation rate to rise year over year, especially on the core side, from 2.8 to 2.9%. That's not that significant. It's pretty smooth. But the headline CPI for May year over year, from 3.8 to 4.2%. We joke that the headline is going to make headlines. Headline will make headlines. If we come in at 4.2%, it's not a super great spot to be in right now, as the Fed would like to get inflation down. They really like PCE, but CPI is a big one, especially for national news. So we are expecting, a little bit of this increase that aligns with the price of oil being up, with this current conflict, with how long we've been going in this more expensive world. It's safe to expect some of these increases on the CPI side. So this week, inflation week, inflation could definitely be going up. And if it does, expect rates to not love that. That only matters if we get no other news. We've got this big old conflict overseas, and any kind of hint at a ceasefire can move the needle. And at this point, there's been hints so often that I'm not even sure how seriously anyone's taking anything right now. But the news cycle is still moving with war news. So hopefully we get some good news on that side that can de-escalate our bond trading situation right now, because the 10-year Treasury Not where we'd like to be at the 455 mark. Just getting under 450 down to that 443, 442 that we saw a little bit of last week gave us some nice respite on rates and improved things just a little bit. So that's where we're trying to go to. We're moving the wrong direction slightly this morning. We're going to be just on the hook for headlines and seeing what goes on there. So moving on with the slides here, talking about the Fed funds rate. Yeah, I hadn't seen this yet because, again, traveling. And, thankfully, the Hampton Inn is taking care of me here. Look at this little coffee cup. Makes you smile. Mm-hmm. I've made some jokes about the Hampton Inn because when you drive by, this thing's a little dicey. But, man, great room, nice people. If you're traveling to Salt Lake City on purpose, which I don't imagine many people are right now, I've got a lot of friends here, so I'm happy to see them. But Salt Lake City is not on my vacation destination calendar lately. Maybe it should be because it's beautiful. The Hampton Inn, if you need a budget accommodations. Bad stuff. Look at this, man. This chart. This is not what you want to see. We've been playing around with this stagnant Fed funds rate stuff. We talk about Warsh coming in, going to be a rate hawk, and everyone's like, yeah, rates are going to go down, and it's going to be great. And man, like, what can he do? He's one voting member, and it doesn't matter what he can do. There's nothing anyone can do when jobs are up, inflation's up. Fed funds rate's got to go up. We keep pushing this back further and further, but at this point, we're looking at an increase by the end of the year, and that has not been on our radar. We're looking at holding for a while. Nothing else in the future really mattered. I do still agree with what Andrew and I were talking about a couple of weeks ago, which is, hey, an increase to the Fed funds rate isn't necessarily a bad thing for interest rates. It could signal that we've hit this bottom bump, and now the Fed is just playing the game of maintenance, of taking the market where it is and making adjustments as needed. Adjustments are usually good things. Fed funds rate going up can bring things down a little bit. It's not like mortgage rates are directly tied to the Fed funds rate. I say this a lot, but markets move based on anticipation of what they believe is going to happen, not in reaction to. So if we know that an increase is coming, if the Fed members kind of project that out a little bit, then we can expect it. We know it's coming. We'll see it and react accordingly. So an increase to the Fed funds rate isn't the end of the world, but it will make headlines, and it's something to be able to talk to people about that are just expecting, rates are going to go down, Fed's going to lower rates. Nope. We don't have the data for that. The data says not only do we need to raise it once, we may need a second increase by 2027. So we'll see where that goes, and we'll keep keeping on it. This is kind of the worst it's looked in this year so far as working through these. But the end of conflict in Iran will certainly move the needle on this a little bit. All right, getting into the ugly stuff. What happened to interest rates last week? You almost got to zoom in to see that tiny little spike at the end of the week. It's not a great spike, but it is a spike. It's a very, very real spike. We're moving in the wrong direction. Overnight average here has jumped up, well over 6.5. It's not where we want to be. So we really just have to deal. We're still going the wrong direction this morning a little bit. 667 or so on the 30-year fixed overnight average. Hanging out in this range is not the worst thing that could happen. The mortgage-backed securities trading well below a 25-day, 50-day, 100-day moving average. But, we can get 30, 40 bips back on a daily basis. There's a lot of volatility, a lot of movement right now. So we're just going to watch what happens. Rates are still good enough. There's still enough room for people to buy. We haven't shot up to 7%. There's still some positive here, even though it has been moving in the wrong direction. From the low sixes to the mid sixes. Doesn't change affordability in any massive way, speaking on a macro side, looking at the entire country. So keep your positivity in there, get talking to people. Rates could get worse, and they could continue to get worse as we get through this week. If the inflation numbers are real bad and there's no real war news going on, things are going to move in the wrong direction like they are currently right now. So get your stuff locked, get your people advised, get out there and just do your job, be the advisor. And if you're a new mortgage person, make sure you tune into the sales huddle today, because we're going to be hitting on some bangers. I am super excited. I will not likely be doing this from my hotel room. I will go to the office and have a little bit more, good stuff going on here. So look a little bit better, do a better presentation. But I appreciate everyone being flexible and letting me podcast here from the Hampton Inn. Thank you for tuning in. And Andrew and I will be back next week to talk about what's going on this week, what's going on thereafter, and how to be best prepared to, serve your clients in this market. Appreciate you guys. Take care.